we begin to cover the accounting for state and local governments. We will continue this coverage in Unit 6. For this unit, our objectives are: 1. Define government entities and describe generally accepted government accounting standards and the Government Accounting Standards Board. Understand that two separate sets of financial statements must be created and reported by a state or local government unit. Explain the overall differences between government-wide financial statements and fund-based financial statements. Understand and apply fund accounting to a government entity and identify the three major classifications of funds and each of the individual fund types within those classifications. Explain the structure and reason for budgetary entries, subsequent reporting of that information, and understand and apply accounting for the budget peculiar to government accounting. Explain the structure and reason for recording encumbrances, the subsequent reporting of that information, and apply encumbrance accounting for government entities. 7. Describe the reporting of the acquisition of capital assets on both fund-based financial statements and government-wide financial statements. Number 8, identify the 4 types of non-exchange transactions and explain when each type of revenue should be recognized. And 9, describe the accounting that is utilized for the issuance of a long-term liability within both the fund-based financial statements and the government-wide financial statements. Government entities follow generally accepted government accounting standards established by the Government Accounting Standards Board. The Government Accounting Standards Board is similar to the Financial Accounting Standards Board. Although much is similar to generally accepted accounting principles, there are differences. Here are some basic principles that influence how we account in government. 1. The government serves the people. 2. There is no profit motive, hence the decision-making process and ultimately the accounting is different. 3. Taxation is the principal source of revenue. 4. The process is effected by lawmakers. And 5, managers, who are elected officials, are responsible for other people's money. Government Accounting Standards Bulletin Statement Number 1 sets the framework for government entity financial reporting. The Government Accounting Standards Board requires government entities to prepare 2 separate and distinct sets of financial statements. In 1999, in order to satisfy everyone's financial information needs, GASB began requiring the production of distinct sets of financial statements. The first is the fund-based financial statement. The second is the government-wide financial statement. The fund-based financial statement shows restrictions on the use of resources and measures in the short term, revenues and expenditures from certain activities. The government-wide financial statements report all revenues and costs of providing services each year and all resources available to the government unit. Fund-based financial statements focus on specific activities. The primary measurement focuses on the flow and amount of current resources. They utilize modified accrual accounting. Fund-based financial statements assess fiscal accountability. Government-wide financial statements report on activities as a whole. The focus is on all economic resources. Government-wide financial statements utilize accrual accounting. Operational accountability is assessed. They are very comparable to the corporate financial statements you are familiar with. As mentioned on the previous slide, in order to prepare fund-based financial statements, governmental accounting records its individual activities within self-balancing sets of accounts known as funds. There are three types of funds used. Governmental funds account for activities where service to the public is the main emphasis. The big fund in this area is the general fund. The general fund accounts for all financial resources except those required to be accounted for in another fund. Special revenue funds accounts for the proceeds from specific sources that are legally restricted to expenditure for a specified purpose. This could be used to record revenue from a state's casino that is used for education purposes. Capital project funds are used to account for major construction projects, such as building a new school. Debt service funds account for the accumulation of and resources for the payment of long-term debt principal and interest. The second classification is the proprietary fund. Proprietary funds account for activities of the government where a user charge is assessed. There are two types. First is the enterprise fund. An enterprise fund sells services like a business. An example is a golf course owned by a town. The second is the internal service fund. This fund is established to sell supplies and services to the other funds of the government entity. Even though it is not profit motivated, its operation resembles that of a business. A town may set up its computer center as an internal service fund. The third category is the fiduciary fund. Fiduciary funds account for assets held in a trustee capacity for external parties. These include investment trust funds, private purpose trust funds, pension trust funds, and agency trust funds. The modified accrual basis of accounting used in government fund accounting is a mixture of cash and accrual basis. It could be called the modified cash basis. To be recognized as a revenue or expenditure, the actual receipt or dispersal of cash must occur soon enough after a transaction or event has occurred to have an impact on current spendable resources. Revenues must be measurable and available to pay for the current period's liabilities. It must be both. Revenue is measurable when the cash flow from the revenue can be reasonably estimated. Revenue is available when both of the following are met. One, collectible either during the current period or after the end of the current period, but in time to pay year-end liabilities. And two, legally available to finance current expenditures to be paid within 60 days. Revenue is recognized in the earliest period that both criteria are met. For example, revenue recognized in year one but not collected until the end of year two would not be recognized. But if it was collected in the first month and was legally available for expenditures in year one, then it would be recorded in year one. A business records revenue when a substantial portion of its production and sales activities have been completed and the collection of the revenue can be reasonably assured. Governmental entities receive revenue as a result of such actions as collecting taxes. Under modified accrual accounting, we record the expenditures when the liabilities are incurred. Governmental fund expenditures are recognized in the fiscal year in which the fund liability is incurred. Expenditures are recognized when a transaction or event is expected to draw upon current spendable resources rather than future resources. Because of the focus on current year-end needs of government entities, the term liability refers only to current liabilities. Long-term liabilities are outside the measurement of the governmental accounting focus, and transactions that incur a long-term liability are not recorded as expenditures. Depreciation expense is not recorded for governmental funds under the modified accrual basis. The assets are instead expensed in the operating fund when purchased because they are a current use of funds. There are a couple of exceptions. Inventory and supplies may be expenditures either when bought or used. Interest on long-term debt is recognized on the date due. Unlike generally accepted accounting principles, in government accounting, the budget is recorded in the general ledger. This is a major difference between governmental accounting and generally accepted accounting principles. The government accounting standards require that each government entity should have a budget. The accounting system should provide budgetary control. Schedules comparing budget to actual for the general fund and each major special revenue fund should be part of the financial statements as supplementary information. Government accounting has traditionally stressed establishing control over current financial resources to ensure appropriate usage of the public's money. Thus, they require the budgets to be in the fund-based financial statements. Here is an example showing the recording of the budget in the financial records. The City Council approves a budget for the following year consisting of $1,850,000 revenue, appropriations, which are expenditures, of $1,800,000, and a transfer of $40,000 to the debt service fund. A journal entry is recorded at the start of the year to record the budget. Estimated revenue is debited for $1,850,000. Appropriations is credited for $1,800,000. Estimated other financial uses is credited for $40,000. And a $10,000 budget surplus is credited to budgetary fund balance. Amounts are posted to the ledger. At the end of the year, these entries are reversed and the new budget will be recorded. There is the journal entry to reverse the budget. Amounts are posted to the ledger, bringing the accounts to zero. We are now ready to record next year's budget. The initial and amended budgets are reported along with actual figures for the period as required supplemental information in the comprehensive annual financial report. As an alternative, this information can be shown as a separate statement within the fund-based financial statements. Accounting for encumbrances is a new accounting concept for most students that is used in government accounting to record the commitment to spend in accordance with the appropriations. You may want to think of this as an expected expenditure. It is unique in government accounting. Under generally accepted accounting principles, we do not record items when we order them. We record them when we receive them. In government accounting, for the fund-based financial statements only, financial commitments for purchase orders and contracts are actually recorded in the individual governmental funds by recognizing encumbrances. These balances are recorded when the commitment is made and removed when an actual claim to current financial resources replaces them. These entries help avoid overspending more than the amounts properly appropriated. The encumbrance is considered a break on overspending before bills are actually recorded. In government, it is important to stay within the budget. The encumbrance is normally recorded when a purchase order is issued. The encumbrance account may be considered a quasi-expenditure. The fund balance reserved for encumbrance account is a form of restriction of the fund balance account. The encumbrances are removed from the records when the commitment becomes a liability. Accounting software today allows for entries to be inputted into the system, and the software will create the ledger entries necessary for the creation of both the fund-based and government-wide financial statements. Encumbrances will only be recorded for the fund-based financial statements. Let's look at an example on the next slide. On July 1st, the town's Board of Aldermen approved a budget that included $12,000 for copy machine paper. As we previously mentioned, this would be recorded as a budget entry with a debit to budget revenue and a credit to appropriation copy machine paper for $12,000. The town would probably keep a subsidiary ledger specifically for copy machine paper and show the amount that is budgeted. Also, on July 1st, we send out a purchase order number 32 to WB Mason for $1,000 of copy machine paper. This creates the encumbrance. We record the encumbrance with a debit to an account called encumbrance and a credit to reserve for encumbrance. The encumbrance is recorded in the subsidiary ledger. You can see it shows the amount of the budget that is left to be spent, $11,000. Unlike generally accepted accounting principles, under governmental accounting, this entry is made when we commit to purchase, send out a purchase order for goods. Obviously, this is a major difference from GAAP, as under GAAP we would not make an entry until we receive the goods. With encumbrance accounting, we are showing that we have committed to use some of our funds. In theory, if we did not do this, we could overspend. The original amount appropriated for the copy paper was $1,000. When we get the actual bill, it is $1,075. We make two entries. The first entry reverses out the original encumbrance with a credit of $1,000 to the encumbrance account and a debit of $1,000 to the fund balance reserve for encumbrance account. The second entry records the expenditure with a debit to the expenditure account and a credit to voucher, which is accounts payable, for $1,075. The amounts are recorded in the subsidiary ledger. This results in an additional $75 being charged to the budget and leaves us with $10,925 to be spent. What happens to open encumbrances at year end? Let's look at an example. Our appropriation was $12,000 and we have $500 open encumbrances left. We have a total fund balance of $100,000. At the end of the year, the estimated revenue and appropriations accounts will be closed out. The open encumbrance will be closed to the fund balance account. The reserve for encumbrance will be closed out, and the credit will establish a fund balance reserved for encumbrances. We now have an unreserved fund balance of $99,500 and a reserved fund balance of $500. In government-wide financial statements, acquiring a capital asset is reported as a capital asset and incurring an expense is reported as an expense. However, for the governmental funds on the fund-based financial statements, the reduction of current financial resources that results from the purchase of a capital asset, incurrence of an expense, or payment of a long-term debt is reported as an expenditure. In this manner, the statements report the usage made of the money held by the government activity. On the fund-based financial statements, supplies and prepaid items can be reported by either the consumption method or the purchases method. On the government-wide financial statements, the recording of the acquisition of infrastructure items, such as bridges and sidewalks, is required. Governments often have non-exchange transactions where revenues, such as taxes, are received without a corresponding earning process. To guide the recognition of such transactions, four separate categories have been identified. One, derived tax revenues, such as income taxes and sales taxes, are recognized when the underlying event occurs. Two, imposed non-exchange transactions, such as property taxes, fines, and penalties, are recognized when the resources are required to be used or in the first period when use is permitted. Three, government mandated non-exchange transactions, usually a government grant to fulfill a legally required objective, are recognized when all eligibility requirements have been met. And four, voluntary non-exchange transactions, such as most grants and gifts, are recognized when all eligibility requirements have been met. Governments often raise significant amounts of financial resources by issuing long-term bonds. In the government-wide financial statements, the debt is simply recorded. In the fund-based financial statements for the governmental funds, the inflow of financial resources is reported as an other financing source. Payment of the debt is shown as an expenditure. Long-term debts are not shown in the fund-based financial statements for the governmental funds.